Hello and welcome to the weekly webinar for Stocks Down Under. It's Wednesday, the 17th of November. I'm Stuart Robertson. With me is Mark Kennett. Mark, tell us all about the Semiconductor Conference that we're putting on in conjunction with some of our partners at the end of the month.
Yeah, we're pretty excited about that one. So this will be the third one that we're hosting. Unfortunately, this one will still be virtual. So hopefully next time we do it, it will be in person again. But yeah, we're pretty stoked. So this is our annual Semiconductor Conference. So we've got a whole bunch of companies coming. I think 6 out of the 9 or 10 listed ones on the ASX. Notably absent are Refasim and Pivotal, so the equipment guys. But we've got some stocks that are really hot right now and that you get a lot of attention from investors. So BrainChip, Ebitda Nano, Archer Materials, 40S Memory, Blue Glass, and Blue Chip. A lot of people will know BrainChip, will know Ebitda Nano and 40S Memory because we've talked a lot about those. But Archer Materials may be a little bit less well known. They basically claim to have found the holy grail, and that is quantum computing at room temperatures. So that's really if they can get that to work, that's really groundbreaking. And Blue Glass, I think we've spoken about that one last year at the conference, and Blue Chip was there as well. So if you go to the Stocks Down Under website, right at the top there says the big blue button. Click that and sign up. You can still do it as a subscriber to Stocks Down Under. Thursday or Friday, we'll go out more broadly on social media. So the spaces are limited. So be sure to sign up for that one.
And Mark, I'm particularly looking forward to 40S Memory presenting. They had some recent issues in terms of their technology development, which we regarded as relatively insignificant in the scheme of things, but the stock took a bit of a hit. So this is their first chance to go on the front foot and tell their story post that event.
Exactly, yeah. So we did an interview with the chairman actually last week. That's up on our website as well. I think we posted that on Monday. But this will be one of the local Australian directors presenting, and he'll talk us through sort of what happened really, and talk about the delay. As far as we can see, this is the exact same company as it was 2 weeks ago, only at half the valuation. The only difference in terms of operations is that it's been delayed by 3 months, 4 months, maybe 5, so something like that. But you're getting a very good value, I think, at the current price. So yeah, we're keen to see what David McAuliffe has to say there. All right, so we just included Northern Star on our topics list, a gold play. So take us through what's happening in the gold space.
Yeah, so regular subscribers to Stocks Down Under will know that we're pretty bullish on the price of gold. We think that by the end of the decade, 10,000 an ounce is potentially, I hasten to add, where you could go with the yellow metal. So we talked a little while ago about our thesis on why gold is headed up from here. Naturally, we looked around, and because there's the chart, that peak close to $1,900 an ounce back in May. We're going to have to break through that. 1900 and then maybe 1950. So there's a number of resistance levels that the yellow metal would go through. The recent re-rating in cryptocurrencies probably tells you where gold is headed with a few months time lag. So the commodity is starting to work in our favor. Who do you lay down your chips on if you want to bet on a recovery in the gold price? We're going with Northern Star Resources. They own the famous Super Pit, massive gold mine right next door to the city of Kalgoorlie in Western Australia. They also own several other mines in that state. They own a new mine in Alaska called Pogo, which Northern Star bought a couple of years ago. This company produces 1.6 million ounces a year. By the middle of the decade, they're going for 2 million ounces. So FY22, they think they can do about 1.6, and the all-in sustaining cost maybe $1,100 US an ounce, which is pretty good in the current pricing environment. Importantly, the hedge book is free. So if you've got gold going up, there's only $800,000 of future production actually hedged at the present time at not half bad prices, although slightly below where spot is at the moment. So you get to enjoy all the upside from the currently rising gold price. And there's 56 million ounces in resource. So this company's got a couple of decades worth of production that it can start to tap over time just from the resources that it knows about. In particular, what appeals to me about this one is the Super Pit. There's a picture of it right next to Kalgoorlie. If you recall your history, the late Alan Bond managed to aggregate a whole bunch of underground gold mines in the vicinity of Kalgoorlie way back in the 1980s. Now, he wasn't able to realize the upside of that, but it was called the super pit because you suddenly turned a whole bunch of higher cost underground mines into a lower cost open pit mine, and then go ahead from there. We've been mining gold in Kalgoorlie since the 1890s. And no one really knows how much gold is underneath the super pit at the moment. But for a long time, no Aussie company had a piece of the action. That changed in 2019 when Saracen and Northern Star bought half interest each in the super pit. There'd been a rockfall, so they got it for a bargain basement price. What I like is that they'll be back to more or less normal production by the middle of the decade from super pit. Post that rockfall. And remember, the reason why it's 100% owned by Northern Star now is because of the recent merger with Saracen. And then, if you start doing your exploration work, you can start to really tap the long-term potential of this mine. So I think everyone's going to be surprised at how much gold is actually in the super pit. It really looks good on a forward momentum. So we're encouraging people to go look at Northern Star as a great way to play the upside we're seeing in the current gold price. Now, another one we have on the top picks list, which is a little further down the scale in development, is Geo-Pacific Resources. They're fully funded for their first gold mine, which is called the Woodlock gold mine in Papua New Guinea. It's on a little island called Woodlock Island, about 500 kilometres from Port Moresby. Geo-Pacific have outlined 1.6 million ounces in resource at this mine. If you look at the flow sheet, it's very straightforward. The ore is free milling. Simple carbon and leach processing plant to process it. On very modest assumptions on the price of gold, you get 347 million Australian dollars as the net present value on this project. And remember, it's fully funded. And we're expecting the first gold pour in early 2023. Now, interesting in terms of the near-term potential, they're currently doing a drilling campaign. First of all, to check out the grades at the edge of the pits they're going to dig. But more importantly, they expect to be able to find more resources, which will increase that 1.6 million ounce resource. So there's a lot to like about Geo-Pacific Resources at the moment. But it's interesting, last week the stock took a bit of a hit. Company put out a project update and flagged 3 different issues. If we look at the next slide there, Mark. And those issues were, now there's, by the way, there's Woodlock Island, the little red box at the edge of that slide there. Heavy rains on the island. That meant that they were delayed in terms of putting the carbon and leach plant up. PNG has suffered more than most in terms of COVID-19, so it's difficult moving people in and out of PNG and then over to the island. So that slowed things down a little bit. The interesting thing about the announcement they just made was they're worried about where to put the wharf on the island. They talked about how they found a lot of sediment underneath the ocean where the wharf was going to be located. That was going to change the method you use to anchor the wharf. Also meant that a lot of equipment rolling on and off the island would be actually offloading about 160 meters offshore. So it was all going to get a bit expensive. Not in a way that could derail a project, because you always build contingencies into your capital budget. But it was unexpected. Well, there's a simple solution. You just go back to where the old wharf is, and potentially just develop that wharf. In this case, you can develop it from onshore, and you're offloading from only 10 meters from the shoreline. So when you add it all up, there's only about 3 months delay. Mark, you were speaking of 4DS being delayed by 3 months, and yet the share price halved. We're down about 25 or 30% on this stock at the moment with a similar kind of delay. But still with excellent economics. In fact, the economics are getting better because of the recent increase in the gold price. So this remains a very top pick. Things go wrong, and I say wrong in inverted commas because it's just engineering problems rather than something fundamentally wrong. Things go wrong all the time. For those who are brave enough, this is potentially a buying opportunity.
Yeah, and Stu, if you look at the chart for this one, you can see around the current level, 21 cents. There's quite a bit of support from I think last year, the year before. So with this sort of thing, it can always go lower. Obviously, there's always risk, but it seems like most of the declines seem to be out of the share price. Right.
So yeah, we're sticking with this one. Now, Mark, recently we updated our view on Zip. Tell us how things are going with Australia's leading buy now, pay later provider now that Afterpay is part of Square.
Yeah. So Zip is. Basically, is it worth a punt right now is actually the question. And if you look at our stocks and owners history in the buy now, pay later space. We've always been big fans. Of course, that started with Afterpay more than 2 years ago now. But also Zip, when we wrote about that one, I think November last year, it was right about sort of the price that we are now. Obviously, if you look at the chart, you can see that massive spike to around $14, and it's come back down to below $6 again, is where we are today. But yeah, if you look at where the share price is, what are you getting at the current levels? Well, I think with the acquisition of Afterpay by Square, Zip is probably one of the biggest independent buy now, pay later players with exposure in the United States, and obviously that right now is the biggest market for this sort of offering. Because if you look at online sales in the US, only about 2% of the purchases is paid for using a buy now, pay later service, versus about 10% in Australia. So you've got at least, you can go up to that 10% first of all, but we suspect there's a lot more room to grow also in Australia for buy now, pay later. So you've got a player that's independent from others, and no banks have major positions in it. And so it's really an interesting one from an M&A perspective, I think. If you're a global bank or if you're a fintech company like Square, actually, and you're looking for exposure or a big partner in this space, probably people will have a close look at Zip. It's growing exponentially in North America and Europe. If you just look at the most recent presentation, everything is growing triple digit. And it should be EBITDA profitable in the next financial year, according to about 12 analysts covering the stock. And even if there's no takeover scenario in the cards for Zip, it's trading at multiples that we think are interesting. And this is cheaper than what Afterpay was 2 years ago with all that potential. If you look at the combination of EBITDA to Ebitda Growth, we can see for 2024, the multiple, EBITDA multiple is 34, but the actual EBITDA growth is 82%. And so our preferred metric, EBITDA to EBITDA growth of 0.41, is basically around the level, maybe a little bit cheaper than what Afterpay was 2 years ago. So standalone, we think Zip is actually pretty interesting at the current levels. And then looking at the chart, so you can see around $5, slightly above $5. There's quite some support there from previous trading. So we think below $6. Keep it on your watch list, because if it dips any further, I think you could probably do have quite a decent share price run with this one, either standalone or maybe down the line some M&A activity coming into play for Zip. So yeah, we at these current levels we quite like it again. And then moving, Stuart, to the last topic for today, Graphite. Talk us through what's happening there.
So we've had a lot of people talking to us about lithium just lately. Obviously, the price of lithium's done quite well in 2021. We've been hearing less about graphite, which suggests to me that this commodity, given that graphite is at one end of lithium-ion batteries with lithium at the other, suggests to me that this commodity is set to snap back as well. Well, we had proof of that yesterday. Let's talk about what graphite is, and then we'll talk about why we're talking about it now. Graphite's a battery mineral. You need carbon in the anode, and graphite's the best way to get it. The lithium and other metals are up at the cathode end. You can get graphite synthetically. Natural graphite, which you mine in Africa and many other places in the world, is mostly flake graphite because it tends to flake off from the actual ore body. Different flake sizes: fine, small, medium, large, and jumbo. And if you're doing lithium-ion batteries, you need the smaller flake size. You turn that into a value-added material called spherical graphite, and then you can start putting it into batteries and sell it for a premium. A lot of graphite goes into applications where you need to manage a lot of heat, so-called expandable graphite, and that's where the jumbo and the super jumbo flake tend to go. So that's graphite in a nutshell in terms of why we need it. What's interesting to me is the performance of a newly listed stock yesterday, Evolution Energy Minerals. Just got spun out from another gold company to develop a graphite project in Tanzania called Chilalo. Now, a lot of graphite in Tanzania. Tanzania was a country that was pushing back hard against foreign investors on what it thought was some unfair royalty and revenue sharing arrangements for resource projects. and that caused a lot of graphite projects to get stranded several years ago. That's all changed now. A new government that's done its best to work out arrangements that are fair for everybody. So now Tanzania is open for business in terms of graphite. You can look forward to a lot of ASX-listed companies potentially moving forward from here. But this one, Evolution, with its Chalalo project, they IPO'd at 20 cents a share to raise 22 million to develop that mine. Stock closed yesterday on its first day of trade at 62 cents. Now, that's telling you that graphite is now back as a popular commodity for the same reasons that lithium is doing well. Obviously, the world needs a heck of a lot more of both. Our preferred pick in this space, which investors should go take a look at, Syra Resources, SYR, formerly a very high flyer. If you go back to the several years ago, the stock was about $4 a share. When we wrote about it just prior to the Corona crash in early 2020, the stock was back at 53.5 cents a share. Bottomed in the Corona crash and then improved quite nicely. Yesterday, the stock was $1.27, so that call has worked out quite well. What do you get with Syra? A pioneer of this space on ASX, where they staked out a huge graphite mine in Mozambique called Balama. They're producing there for about 3 years now. That in late 2019, they found they were on the bad end of the stick in terms of poor pricing. So started to wind back their output from Balama. We're now at the other side of that with strong demand coming from China and elsewhere. And the order book is growing strongly. So we're expecting good things from Syra in the next couple of years. A lot of people got burnt with the stock on the way through, so it might take a while to recover. But the fundamentals of the company in terms of having a large graphite mine with different kinds of flakes in the production process are interesting. Now, there's a near-term problem. You would have heard that the world's supply chains are all tangled up thanks to COVID-19. Syra is no exception. Shipping graphite from Mozambique to China and other places is a little bit problematic right now, but we're expecting ultimately the supply chains will return to normal, in which case that company could do quite well. But that and a whole lot of other graphite projects we've talked about in resources stocks down under are probably worth paying attention to now that graphite is back on the radar screen.
All right. Sounds a bit flaky though to me. That's all we have time for today. So watch out for the Geo-Pacific Resources interview that is on our website today as well. We spoke about another topic we spoke with management earlier this week as well. So keep an eye out for that. And we hope to see you next week. And don't forget to sign up for our Stocks Down Under Semiconductor Conference.